Swayam Prabha. Digital India. Educated India.
Hello, this is the second part of our valuation of equity shares section. In the previous session, we discussed about the valuation of shares. We talked about basic approaches, and where we talked about valuation of equity shares can be done directly, and also it can be done indirectly. And indirectly, the valuation of company is done as a whole, and then from there the valuation of shares are derived. And coming to the valuation of equity shares, we discussed different methods, and these methods are like asset based measures, where talked about book value, liquidation value, replacement cost approach. Then we had something like valuation of multiples, where we talk relative valuation. In that we have to value a company based on the peer group in that particular sector where the company belongs to, and taking a comparable, then we valued the company. Then we have got further measures like discounted cash flow based measures, venture capital and private equity approach, and valuation in case of mergers acquisition. In this session, we will be discussing about the discounted cash flow approach for valuation, and also touch upon the venture capital approach, and what is the special consideration in case of mergers and acquisition cases where you have to do the valuation of company also. Coming to the discounted cash flow approach measure, this has fundamentally there are two types. One is a dividend discount model, and second one is the free cash flow model. And the free cash flow model, one has got free cash flow to the firm, from where again the valuation of firm can be derived, and from there one can find out the valuation of equity. That is like indirect approach. Directly also free cash flow to the equity can be found out, and from there valuation of equity can be found out. So, these are the things which we are going to discuss in this session. Coming to the basic approach of simpler approach called dividend discount model. This is the dividend, as we know, dividend is nothing but distribution of cash, distribution of profit in terms of cash to the equity investors. There are certain investors, in fact most of the investors will always like to have dividends in their hand as a return on their investment in a particular equity stock or equity share. So, there will be some companies which keep on declaring very good dividends, some companies they may not declare at all any dividend for that matter. For example, we have got a company like Bharti Airtel. Since its inception it never declared dividend, but in 2009 March around 2 rupees per share it declared dividend in the last financial year. So, it is not necessary that all the companies decline dividend. So, if the company is not declaring dividend, it does not have any history of declaring any dividend, then this model is not going to be applicable. So, this is applicable for certain companies where dividend is declared, and also it is also useful for such investors who invest in the shares to get some dividend as a regular source of income. For instance, if you have got a pensioner or senior citizen who invest in the shares of the company, and he will look forward to this dividend as a regular source of income at the post retirement stage. So, for them dividend valuation model could be most appropriate, but there will be several investors who invest in the shares of the company not to get dividend, they are rather look for something like a market appreciation, capital appreciation. For them dividend discount model may not be useful, but in any case dividend discount model is a very age old model, also is a robust model if you one has to believe dividend as one of the value driver or one of the driver for the share price. In that case it is going to be useful, and from there we will move on to the free cash flow approach. Coming to the dividend discount model, what happens in this, the company is going to declare some dividend, and investors are required to expect that this is going to be dividend in future year. And as we know, the valuation of any company, a valuation when it is based on cash flow is nothing but, if you have to V0 is today's value, then value is nothing but a function of the cash flow, where in the in the future year, and where the t is something can range from 1 till infinite. In this case, the valuation of the share will be function of, instead of cash flow, it will be now it is called dividend t, where again t can be from 1 to infinite. So, to make it a present value approach, where because the dividend of 1, 2, 3 is going to come up to 1 or 2 or 3 years hence. So, in the such case is nothing but we have got dividend t divided by 1 plus k, k is the appropriate discounting factor to the power t, and we make a summation where t is equal to 1 to infinity. So, if somebody knows what is the dividend for year 1 till infinity, in that case it can be applied. So, it is quite possible that one can find out the dividend for a near period like 1 to 5 years, 4 years, 6 years, something like that, and then one can expect that our dividend is going to stabilize and its dividend may grow, dividend may not grow. All these assumptions can always be made. So, at the end of the day, one has to have the dividends for first year, second year, third year up to infinity year, and then discount at a particular cost of equity or discounting factor, because it is being done for the equity investors point of view. So, the appropriate discounting factor is going to cost of equity. Cost of equity is nothing but the return expected by the equity holders from the company for that matter. So, in this case what is happening? So, price P 0 is today's price, is the price of equity share today, and it is nothing but D1, D2 dividends per share for year 1 and 2 and like. So, one has to typically expect or estimate dividend up to the infinite stage, because equity investment is something which is going to be there for a long, very considerable long period of time. It is, there is no time limit, it is actually a perpetual investment by the equity shareholder. Equity shareholder may exit from the particular company at a particular point of time, but company has issued the shares keeping in mind that the shares are not going to be returned back, or the cash is not going to given back, unless the company some other time decide the company is going to buy back the shares from the market. That is a different case which is decided at that point of time only, but while issuing the shares, the company never says that these shares are going to be redeemed, particularly equity share is going to be redeemed after a certain point of time. So, that is why the time horizon for this valuation is infinite period. So, it is not possible to find out the dividend which is going to be there after even 10, 15 or 20 years. So, in that case one has to make an assumption about the pattern of dividend. The dividend may grow up a very high rate, because the company may be under very high growth phase, then the growth may decline, then the growth may stabilize. So, keeping those things in mind, the valuation can be actually done. So, all these assumptions can be kept into the model, and then valuation of the shares can be taken care. So, coming to the different approaches of valuation model and dividend discount model, we can have one model where it talks about there is no growth in dividend. In this, there is no growth in dividend, is like a perpetual, and the dividend that you are going to get is going to be the same for all the years from 1 till infinity. In that case, the valuation of nothing but it is simply the dividend per share of the particular company divided by the discounting factor. You do not have to discount all the years dividend separately, we can just divide d by k e, and in that case the values come. So, if you look at this example, this company, one of the company, let us say the dividend per share today is rupees 5, and since the dividend is not going to grow, it is going to remain constant till infinity, and the cost of equity is given as 15%, then the value of the share is nothing but 5 by 0.15. So, that comes to rupees 33.33. So, this is the value, assuming that the 5 rupees per share and there is no growth in dividend. So, but it is quite unlikely that dividend of a particular company is not going to grow, because the dividend of a particular company depends upon the profitability, earnings of the company, and we always expect the earnings of the company is going to change over a period of time, it is going to expect it to grow. It is a natural expectation that the company should grow and the profit and everything also should grow in accordingly. In that case, the dividend is supposed to be growing as such. If that is the case, if somebody can find, one can find out with a suitable measure that yes, the dividend or growth of the company is going to be something like this, dividend is going to grow at a particular rate, accordingly this model can also be changed, and then the dividend discount model can also be applied. So, if you look at the next model talks about constant growth in dividend. In this case, we have got the dividend of the next year, that is D1 divided by K e minus G. So, this is nothing but dividend with a growth. So, if you look at this example, in this case we have got present dividend per share is 5, and which is expected to grow at 5% per annum till perpetuity. That means it is a stable stage and is going to grow for 5%, so the growth is not going to change over a period of time, and the cost of equity is let us say 15%. In that case, one has to find out the D1, the dividend 1. The dividend 1 is nothing but the dividend 0. So, D1 is nothing but dividend 0 into 1 plus G. So, in this case we have got rupees 5 into 1.05, the 5% the growth rate. So, that comes to rupees 5.25, and this rupees 5, then the value of the share, the price per today should be, so 5.25 is the D1 divided by K is given as 0.15 minus 0.05 is the growth. So, that gives us 5.25 divided by 0.10, which gives us rupees 52.50, that is 52 rupees 50 paisa is the dividend, is the price of the share. If the dividend is going to be 5 rupees today, which is expect to grow 5% at a per annum for all the years to come. So, this is the example for dividend valuation model, where there is a constant growth, but it is quite possible that dividend will not grow at a particular rate, constant rate immediately, depending upon the growth pattern of the company, industry, and where the company is established. The dividend of the company actually can grow at a high rate in particular stage or low rate for that matter. Then the growth may change from, may decline or may increase, and accordingly the dividend is going to change. In that case, we cannot apply the simple measure like this constant growth model. We have to capture this constant growth model also, and also the other factors into consideration we have to consider. So, if you look at that, the other approach is that you have got dividend called multi-stage growth model. So, in the multi-stage growth model, that means the growth in dividend is not going to be same for all the periods to come. So, dividends may go at a very high rate in the initial years, then it may decline to certain rate, then it may stabilize for that matter. So, in that case, one has to, what has to do here is one has to estimate the dividends for different years of supernormal growth or high growth period, then individually, and then we have to find out the dividend when the dividend actually stabilizes. So, if you have a company where there is a high growth phase of this company, or the supernormal growth phase is let us say 4 years, and then the stable growth phase arises after 4th year. So, in that case one has to find out the dividend for first year, dividend for second year, dividend for third year separately, then dividend for the 4th year, which is going to grow at a particular constant growth rate. So, this D4 can be used with this growth to find out the value what is going to be at the time called T3, and this time 3, what the value which is decided based on the dividend of the 4th year and the constant growth, then that is nothing but the known as terminal value at the time of 3rd year. So, the fundamental approach is like this: P0 is equal to, when the constant growth, it is nothing but D1 by K E minus G. So, in that case, if it is going to be P3, then it becomes D4 by K E minus G. So, this P3 is also known as something called terminal value. So, terminal value is going to be now D4 divided by K E minus G. So, once the terminal value 3 is found out, and we have also got dividend 1, dividend 2 and dividend 3. Now, the valuation becomes simpler. This valuation becomes now a function of D1, D2, D3 and terminal value 3. So, what will happen in that case? We have a D1 divided by 1 plus K E plus D2 divided by 1 plus K E to the power 2 plus D3 1 plus K E to the power 3 plus terminal value 3 divided by 1 plus K E to the power 3. So, this is going to be the price per share value of the equity as per a model, where the D1, D2, 3 has been found out separately applying the supernormal high growth, and the terminal value has been found out by applying the 4th year's dividend as well as the stable growth from the 4th year onwards. So, this is the basic approach for valuation of a share where multi-stage growth is there. In fact, this D1 to D2 growth can be different from D2 to D3. So, in that case we are saying that in this supernormal stage growth there is one growth is very high, another growth could little lesser growth, then it comes to stabilization, it becomes a 3 stage growth model. We can have a 2 stage model or we can have 3 stage or more than 3 stage model also. So, if you look at this example here, so in this case we have got a present dividend of the company is 4 rupees, which will be growing at 12% for the next 3 years and then 10% for the subsequent 2 years, and after which the growth will stabilize at 8%. So, if the cost of equity is 15%, what is the value per share, that is our exercise here. Then what happens, we have estimated like this. So, 4 rupees the D0. So, in that case D1 is nothing but 4 rupees into 1.12, because for 12% is the growth what that happened, the supernormal growth, high growth during the growth period as such. Then D2 is nothing but twice this getting multiplied 1.1 to the power 2, so it becomes 5.02. D3 nothing but 1.1 to the power 3, so 5.62. The D4 is 5.6 to the power into 1.10, because after third year the growth rate declines to 10% as we have given here. So, growth rate is to 10% for the subsequent 2 years and then it stabilizes to 8%. So, 5.6 to 1.1, so D4 is 6.18, D5 is 6.80. Then we have got D6 which is nothing but 6.80, that is say 8% growth upon the D5 is 6.80, it becomes 7.34. In fact, this D6 is going to be used to find out the terminal value at the end of 5th period. That is why the D6 has been founded, because the D6 onwards is a stable growth model which will give a terminal value at the end of 5th year, then we can apply the model and find out. So, if you look at, so the terminal value at the 5 is nothing but D6 divided by K minus G, that is 7.34 was the our D6 divided by cost of equity which was given as 15% and the growth was given at 8%. So, 0.15 minus 0.08, that gives us 104.91 is the terminal value, and this value is like the 5 year dividend that we got 4.48 to 6.80, then the 104.91 they are discounted at the respective rate, that is 1.15 15% discounting factor. So, first year is discount 1, second year discount twice, like that we have got a value per share of 70.46. So, this is the approach for valuation of shares as far as the multi-stage growth model is concerned. Basically, we find out the individual dividends for individual years in the supernormal or very high growth phase, then we find the terminal value at the time when the stable growth arrives, and then the terminal value is also brought to the today's present value, depending on terminal value. If it is 5th year, so discount 5 times. Similarly, other dividends are also discounted depending on the time period, and a summation of these figures gives us the value per share. This is the approach of dividend model. Then we have got the next model is called free cash flow approach. So, before we go to free cash flow, we should know what is a free cash flow as such. So, what happens, the company makes profit, then the profit will be there in terms of cash or non-cash, whatever that may, the profit will be there, expected to be cash profit. So, from the cash, whatever cash profit or cash surplus has been generated, that cash is going to be used for certain activities, like maybe for future expansion or the repayment of debt. Company also can raise other finances, can also get the money for that matter. So, all those things cash flows are going to be there, and the moment there is no encumbrance on the cash flow, there is no claims of any outsider party which you have to, company has to settle. All these things are taken care of, whatever cash flow is left for the company is called the free cash flow, and that free cash flow belongs to the stakeholders. Depending upon the approach, there is all stakeholders are equity, depending on that the cash flow belongs to different stakeholders. So, in that case what you have here in the free cash flow approach, we have got something called free cash flow to the firm. So, what happens in this case from the all stakeholders point of view, or you have got something like free cash flow to equity. So, there you talk about free cash from equity holders point of view. So, by using the free cash flow for the firm, the company can be found out, the value of the firm can be found out. Then from the value of the firm, one can also take out the valuation of value of any debt the company has, then it can be or valuation in other stakeholders is there, that can be taken out, then the valuation of equity can be found. If the company is totally equity financed, there is no debt, there is no preference share capital, in that case the valuation of firm as per free cash flow approach will be also same as valuation of equity, because there is nothing there to be deducted from the valuation of firm, because there is no other outside stakeholder for that matter. Outside stakeholder means we are talking about non-equity stakeholders. So, whatever value of the firm is there, that entirely belongs to the equity holders. So, and then we can also use the free cash flow to the equity, and the valuation equity can be found out directly from there. So, what happens, let us discuss about different models there. So, at the end of the day, there is no fundamental difference between the valuation of firm and different cash flow approach like dividend model or free cash flow model. So, what happens in this case, actually dividend becomes a special case of cash flow. So, instead of taking cash flow for the company, free cash flow for equity or free cash flow of the firm, the valuer is taking the dividend as the proxy for the cash flow there. So, the basic approach that we discuss in dividend discount model, discounting the future dividends to find out the value share, those basic approaches remain same, but only difference is that how does one estimate the free cash flow for a company or for equity shareholder for that matter. So, that is the crux of free cash flow approach compared to the dividend discount model, because dividend is something which can be possibly estimated using the past dividends of the company, and it may be easy to forecast dividend, but for free cash flow calculation a lot of estimates, lot of assumptions, lot of calculations have to be done for that matter. So, what happens in the firm valuation? So, in this case we value the companies, value of the firm is taken care by discounting the expected cash flow for the firm, and that is the residual cash flow after meeting all operating expense and taxes, but prior to debt payments. So, debt payment is not taken care, because whatever cash flow is found out for the firm, that should take care of the debt payment. So, that is why debt payment is not taken out, and this whatever the cash flow to the firm is found out, that has to be discounted at something like an overall cost of capital, that is called weighted average cost of capital, because in the numerator you have got the cash flow to the firm. So, the denominator in the discounting factor has to be also has to represent the overall expectation of the all the investors, that is nothing but again the if there is a two in types of investor particular company, that is a debt investors and the equity investor, in that case the cost of capital will be taking care of both the rate of return expected by equity holders as well as debt holders, and accordingly something called weighted average cost of capital is found out based on the weights of equity or debt. So, the basic thing is that there is a numerator you have got cash flow to the firm. So, discounting factor accordingly has to be the overall discounting factor, keeping all the investors keep in mind. So, once you have the expected cash flow and discount it, then we have the value of firm, and the value of firm also can be used to find the value of equity. So, from the value of the firm one can find out, take out the value of preference share capital if there is there, then value of debt can be taken out, and whatever left over is called the valuation of equity for that matter. And this valuation of equity whatever you get, we will get the valuation entire equity of the particular company, and by dividing with number of shares of the equity, number of equity shares, one can find out the value per share. So, coming to the next one, there is equity valuation. So, in this case we do not consider the valuation for, rather what you do. So, we got the residual cash flow after meeting all expenses, tax obligations, interest and principal payments, because here what happens, it is only for equity holders. So, if there is a cash flow generated by the particular company to the extent of 50 crore, so this need not be taken as the cash flow for the equity holder, because out of this 50 crore, let us say 5 crore interest has to be taken out. So, that remains 45 crore. Then let us say there is a scheduled debt repayment of, so this is our interest and this is our scheduled debt repayment that takes place. So, that gives us 35 crore, which is actually available for the equity holders, but it is quite possible that out of the 35 crore maybe 20 crore is required for expansion, and that is the equity portion of financing the expansion. In that case 15 crore is going to be the free cash flow for equity. So, let us keep in mind we talked about equity portion of financing, that means this 20 crore is not the total expansion. Actually expansion may be to the extent of 40 crore, and if the company has a debt equity ratio of 1:1, so 40 crore is going to finance 20 crore through debt and 20 crore through equity. So, in that case, so 35 crore whatever is left over for the company after paying taking care of interest and principal repayment, 35 crore is left. So, 20 crore will be used out of equity to finance that. Other way around, this can also be found out. So, 35 crore is the figure that we got, then the company gets 20 crore as debt, that is the debt, this is the debt the company is raising additional debt. Okay. So, one can see here there is a 20 crore of debt raised as well as 10 crore of debt repayment that took place because of the prior commitment. So, the total cash flow available for the company equity holder is now 55 crore, but we require actually expansion, how much we require to the extent of 40 crore for expansion. So, in that case what happens, the 15 crore is now the free cash flow for equity. So, either we add the debt inflow, then take out the entire cash outflow because of expansion, or we do something like this, that ultimately on 35 crore you just take out the equity portion of expansion requirement, then you find. So, both the things has given the same value. So, that is one. Another approach is that if you have got a x crore of expansion, then if the debt ratio is d%, then equity component will be x crore into 100 minus d%. So, this will be taken out to find out the free cash flow for equity. And besides expansion requirement, we talked about, when we talk about expansion requirement, in that we are talking about expansion for long term assets as well as for the short term assets. So, possibly this 40 crore that you have a figure here is taking care of both capital expenditure is equal capex as well as any short term assets net of any short term liability, that is called the net working capital. So, this together it is there. If this 40 crore is only capital expenditure, then we have to also find out the net working capital requirement, and accordingly the free cash flow for equity will be changing for that matter. So, this is the simpler, very simple approach for estimate the free cash flow for equity. Once you have the free cash flow, whether it is for equity or for the equity or it is for the farm, what happens here? This particular, this is equity or free cash flow for the farm is going to be there for year 1, 2, 3 like this up to period infinity. So, like in dividend model you have D1 to D infinity, like here also I have got free cash flow for first year, second year, third year like that up to infinity. So, one has to forecast this free cash flow for the farm or free cash for the equity as the case may be from first year till infinite period with certain assumption like growth and all whatever that may be. So, this has to be estimated. So, the free cash flow estimation has got a lot of requirements to be taken. So, in the difficult part of this particular approach is only the estimation of free cash flow, and which is the crux of the model as such. So, as you have, as I mentioned also here, the dividend discount model is nothing but a specialized case of equity valuation. In this case, the cash flow to equity is replaced with something a dividend to the equity holders. Coming to the generic discount model as you have discussed earlier. So, we have got the cash flow 1, cash flow 2 like cash flow n number of periods. So, instead of infinite we have got n number, that means the investment horizon for the investor is n number of years, definite horizon for that matter. Okay. And then we have got a cash flow it could be farm. So, it is a pre-date cash flow is equity, after date the cash flow. So, in farm before date what the cash flow is there, that is the cash flow for the farm. In equity after date cash flow will be considered. Then you have got the growth here, growth in the earnings, and growth in which will be also driving the growth in equity, and growth in equity is nothing but growth in net income, growth in earnings per share. Then with what happens after certain time, this is the high growth period, and then the company comes to something like a stable phase, and the stable phase growth with the CFN can be used to find a terminal value. And so, you have got the estimation of cash flow for the CF1 till n year, then you have a terminal value at the time of nth year, and then we discount them with a particular cost of capital. If it is a free cash flow for the farm, we take the cost of capital or the weighted average cost of capital. If it is the free cash flow for equity, then you take cost of equity into consideration. So, based on that, the relevant cash flow and relevant cost of capital or cost of equity, we end up find the valuation of the farm or valuation of equity, and this valuation of farm also can be used to find out the valuation of equity indirect as per indirect approach. So, what happens, the next thing, that what are the different ingredients that drives the free cash flow for a farm or for a or equity for that, any free cash flow for that matter. So, the different thing that drives the free cash flow is, one is the discount rate. So, one is the discount rate is called cost of equity or cost of capital. So, cost of equity will be used for company for the approach where you are going to use something like free cash flow for the equity. So, cost of equity, there could be multiple models of cost of equity return expected by the investors. One of the popular model that is used for cost of equity is the CAPM approach that we have discussed some time back, that is called capital asset pricing model. And as per CAPM, the return on any stock, ith stock, is nothing but risk free rate of return plus beta into RM minus RF. As you have discussed in our earlier sessions, beta is nothing but the systematic risk found out by regressing the return on the market as independent variable and return on the stock as the dependent variable. Beta is found. High beta is supposed to be high risk, low beta is supposed to be low risk. So, this is taking a risk component, this is a risk free component. So, if you have got a particular company where the beta is, let us say 1.20 and the return on market index or portfolio, the benchmark for that matter is, let us say 15%, and if the RF is, let us say 8%, in that case the RI, which is nothing but again used for finding nothing but cost of equity, is nothing but 8% is RF plus beta 1.2 into RM is 15% minus RF is 8%. So, that gives us 8% plus 8.4%. So, that gives us 16.4%. So, the discounting factor or the cost of capital for cost of equity for the matter is now 16.4%. So, if you are finding out the valuation of equity with a free cash flow to equity approach, then the 16.4% is going to be the relevant discounting factor. So, after getting this 16.4% discounting factor, so there is a cost of equity is 16.4%, and if the cost of debt is, let us say on a post tax basis, if it is, let us say 10%, and the debt to equity of the particular company is, let us say 50:50. So, equal weight is there, then the cost of capital called simple called K is now 0.50 into cost of equity plus 0.50 into cost of debt. So, that gives us 0.50 into 16.4% plus 0.50 into 10%. So, that gives us 8.2% plus 5%, that gives now 13.2%. So, if it is free cash flow for the farm, so the relevant discounting factor is cost of capital. If it is a free cash flow for equity, the discounting factor will be the cost of, the discounting factor is going to be the cost of equity, which is nothing but 16.4%. So, depending on the type of cash flow, the discounting factor is going to be changing. So, next is that you have got the estimation of cash flow estimation of cash flow depends on several things. One, the fundamental driver of cash flow is nothing but the operating income. Operating income is that income which is generated out of the main line of activity particular business. So, the company is into selling of FMCG products. So, operating income is nothing but the selling the whatever income is generated by selling the FMCG products only. It will not be considering any other income, that is like income on investments, dividends from subsidiary company, all these things are not considered in the operating income, because that is something non-operating income. And operating income is obviously found out by taking out the operating expenses from the operating sales income, and then the operating income, and one has to adjust for the tax there. And so, if the operating profit is x, so you multiply 1 minus t, it becomes now operating profit after tax. So, in what happens if operating profit before tax is rupees 50 crore. So, the operating profit after this is called net operating profit after tax, problem was no part, is nothing but 50 crore into 1 minus tax rate. So, if the tax rate, let us say tax rate is 30%. So, the operating profit now becomes 50 crore into 1 minus 0.30, that becomes 35 crore is the net operating profit after tax. So, this is the way the operating income is found out and the tax is taken care. This tax is usually the corporate tax of the particular company, and the corporate tax of the company can be different from whatever has been prescribed by the government of that particular country for that matter. So, in such case, if the company is in a position to have some better tax planning and is, let us say the corporate tax rate by mandated by the government is 30%, but the company is somehow able to manage like 20% tax rate, in that case the effective tax rate becomes actually 20%. But over a period of time, what happens, the company tend to have a corporate tax rate which is equal to the government's prescribed tax rate. So, if nothing is given, then we can take the prescribed corporate tax rate of the government, particular government, as the tax rate in this particular valuation. Then we have got estimation of capital expenditure and net working capital. So, how much of money is going to be there that, and which will be actually used for capital expenditure, that has to found out. In that case, we have to also estimate the capital expenditure requirement, and capital expenditure requirement depends upon the growth that is planned by the particular company, and the growth is going to be higher, obviously capital expenditure is going to be higher in that case. And beside the capital expenditure, one has to also look at what is the net working capital requirement, why nothing but, because there will be also investment in the current assets, and this current assets also going to be partly financed by the current liabilities. So, if you have got a current assets requirement of rupees 20 crore, and if there is going to be current liability to the extent of rupees 5 crore, so the difference is nothing but net working capital, which is nothing but rupees 15 crore. So, this 15 crore is the requirement to be taken out of the free cash flow, there is a farm or equity, as the case may be. So, instead of 20 crore to be taken, it will be actually 15 crore, because 5 crore is anyway being financed by current liabilities. So, this 5 crore is not required out of the free cash flow that we are going to find out for that matter. Then one has to also find out the growth rate. So, growth rate is a very important aspect of cash flow, because the cash flow is not going to remain constant from period to period. Cash flow is going to change from one period to another period, and that depends on what is the growth is going to happen. The popular formula for growth that we have also in dividend discount model, dividend model, is nothing but G is equal to B into R, where B is nothing but retention ratio and R is nothing but return on equity. So, if it is a free cash flow for the firm, so retention ratio is nothing but the reinvestment rate. So, retention is something where the company keeps the money for the growth purposes, internal growth purposes, and does not distribute anything. So, this is the retention ratio, or otherwise known as the reinvestment rate, and then your return on equity. If it is a reinvestment rate for the entire firm as a whole, then in that case instead of return on equity, we replace it with something called return on capital. So, if the return on capital ROC is 12% and the reinvestment rate which is called B, let us say 60%. So, the growth comes to 12% into 0.6, that comes to 7.2%. So, this is the growth which has to be used to find out the cash flow of the subsequent year, which is nothing but a based on the growth upon the previous year's cash flow. So, these are the certain things to estimate the cash flow. Then in general, generic model for free cash for the firm nothing but what happens, operating profit, that is earnings before interest and tax into 1 minus T plus depreciation. Why depreciation is there? Because depreciation has been deducted to find out the earnings before interest and tax, because depreciation has got a certain tax advantage. So, if the company has got an earnings before depreciation, interest and tax of rupees 40 crore and then it has got depreciation of let us say 10 crore. So, it becomes now 30 crore is earnings before interest and tax and the tax rate is 30%, then you have got 9 crore, then it becomes 21 crore is the net operating profit after tax. Then in that we add depreciation that we have already here, that is 10 crore. So, we have got 31 crore actually the cash profit for that matter, and from this 31 crore we take out capex and we also take out net working capital, that gives us the free cash flow for the firm. So, this depreciation has been taken out from this 40 because tax is going. If this depreciation is not taken out, this is a company, there is a one company that is called which has not got any depreciation to claim. So, this is nil. So, this becomes now 40 crore. The tax at 30% becomes now 12 crore. So, the net operating profit is more than 21 by 28 crore, okay, but the tax outflow is now 12 crore instead of 9 crore. So, the difference between these two is nothing but rupees 3 crore, and this 3 crore has been found out, can be found directly by having 30% of depreciation, that is 10 crore, that gives us actually rupees 3 crore. So, since this company is able to save a tax of 3 crore, that is why depreciation are deducted, and since the depreciation does not involve any cash outflow, it is only a book entry in the books of accounts and it takes care of reduction tax as such, that is a depreciation added to find out actually the cash flow 31 crore. Then we take out capex and net working capital, then we got the free cash flow for the firm, and this free cash flow for the firm can be again adjusted with for the debt repayment or debt raised or interest payment or any other outsider investor stake other than non equity investors, that gives us. So, adjusted for these all these factors, that gives us free cash flow for equity. Coming to the next one, next one example here you have got where this is a company where you have got the high growth phase which is 10 years and stable growth phase is after 10 years is called is there, and the reinvestment rate for this company is let us say 65.98%, which has been estimated using the growth and all those things into consideration, or the past history, and it also depends on what is the expansion requirement. Then return on capital, this is reinvestment rate for the company. So, it is like return on capital is the thing, then you have got expected growth rate is now reinvestment rate and multiplied with 6.59%, that gives us 4.35% the expected growth, which is in case of high growth phase. Then you have a stable growth phase. So, this is a two stage model, one is a high growth phase, then you have stable growth phase. In fact, it can also be a three stage model where the high growth phase can possibly divide into two parts, a super normal, super high growth or the high growth, then you have a stable growth. So, in any case the stable growth model, in stable growth phase you have 59.36% is the reinvestment rate and 8.42% return on capital, multiplied these two things, that gives us 5.0%, and the cost of capital is found out for high growth phase separately and also for the stable growth phase separately, because this is expected that high growth phase is supposed to be little more riskier, in that case the beta of the particular company stock is not going to be same. So, it is going to 1.01 compared to 1.00 in case of a stable growth. Then you have got the cost of debt. So, 5.50% and which remains on the 5.50%. The debt ratio for this company is 19.92% in the high growth phase, whereas it is 30.00% in the stable growth phase. Then applying the appropriate this beta has been used with the appropriate return on market and return on RF that you have discussed previously, where you talked about RF is plus beta into RM minus RF, that has given us certain cost of equity, and both this cost of equity that you estimate and the cost of debt applying together, we have got a cost of capital the 9.17% and 8.42% respectively in high growth phase and stable growth phase, and there is a tax rate for the company is 35% both in high growth phase as well as the stable growth phase. In that case, the valuation we will look at how the valuation is done. So, what happens in this case? First of all, we have got the earnings before interest and tax, that is like for year 1 is $1,723 million going to something like 2005 to 8. This is supernormal high growth phase, then you have got a normal growth coming after 10th year, and then from the respective years the reinvestment amount has been deducted. So, 113 that is applying the reinvestment rate of 65.98% or the 59.36% depending on that. Here it has been 59.36%, it is 65.98%. Then you have got free cash flow for the farm from 586 crore, like that it has grown 61263 like this, it has become now 860, and the terminal year the cash flow is now 1078. So, this is the terminal value, the 11th year, which has been used to find out our terminal value T0. So, by dividing that cost of equity minus the growth. So, you can see here the cost of equity was the as a cost of capital is 8.42% minus growth is 5%. So, that is nothing but the K minus G here. So, 0.842 minus 0.05. So, that whatever the cash flow is there, that is we have got now 31,496 is our terminal value. So, this terminal value which is coming at the end of 10th year is discounted to bring it to here, along with the individual cash flows also have been discounted at the respective cost of capital, and then the farm value has been found out at 17,500 crore. Now, one more thing one has to look at in the valuation of farms is that whatever valuation that we talked about, that is based on free cash flow for the farm, we took something like net operating profit after tax, then adjust for depreciation, like that we kept on doing. So, this particular profit is based on the operating revenue, which is driven by certain operating revenue, which is driven by something like operating assets, but it is quite possible that the company has got certain non operating assets in terms of excess cash. That means, some cash is there by the company which is actually is not used by the company for generating any income, is something like idle. In that case, whatever operating profit has been found out, it is driven by those assets other than those excess cash. If that is the case, but since the cash is always there with the company, so whatever value has been derived by the method, that is the value of the total operating assets of the particular company, and to that what we do, we add this cash component. So, in this case we have got 4,323 is the cash. So, total we got now 17,500, which is nothing but discounted value of all this free cash flow plus cash of 4,323, that is the value of total farm. From that the company's debt has been taken out, that is existing debt is 8194. Then comes the valuation of equity, that gives 13,630. Then there may be some special cases where there could be the company could have certain options with certain option holders, which actually gives a right for the investor, the option holder, to buy the share of the particular company at a particular point of time. So, this has got certain rights over the assets of the company. So, in that case the value of the option also can be found out by applying a suitable mechanism, like possible one can use like Black and Scholes model to find out the value of the option. So, this option holder also has the claim over the assets or the value of the company as such. So, this entire value that you got, that is 13,630 crore, is not the value of the equity holders at present. It includes certain claims of the option holders, which is found out by having a particular option valuation model. So, ultimately we take out that, and whatever value has been found out, then number of shares you divide. So, the value per share comes to now $13.14 as per this particular case, and you can look at here. For the discounting factor, it has been used. We have got 3.58% the cost of debt, 10.58% is the cost of equity, and 80.08% the cost of the weight of equity, then 19.92% the weight of debt. So, applying that, you have got 10.58% cost of capital. This has been used to discount, and ultimately got 7,500, and then we can also see here the risk free is 5%, the beta of the company stock in the high growth phase 1.01, then risk premium is nothing but the market return minus risk free return, that is 5.5%, and in fact this beta also can be estimated using like something like unlevered beta and firm's debt equity ratio. So, this is typically for this company we got unlevered beta, which is not levered company. The company has no debt, so we got the unlevered beta, and this unlevered beta can be refined to find the levered beta, because by default beta, when you say it is beta is nothing but levered beta, this is actually beyond the scope of this particular discussion, but this unlevered beta and levered beta concept can be used for certain companies, actually the company which is actually not listed. So, for them the beta is not possible to found out. In that case what happens, we can find out the beta of comparable companies, and this beta is actually levered beta, and this levered beta can be adjusted to find unlevered beta for the respective companies, and one can take then unlevered beta of the particular company by applying this formula like this: levered beta divided by 1 plus d by E, it is adjusted per leverage, and 1 minus t. So, that gives unlevered beta. And once you have unlevered beta for 1, 2, 3, 4, that is 5 companies, take the average of unlevered beta, and that is the unlevered beta is supposed to proxy unlevered beta for the target company which is actually not listed, and this unlevered beta can be used to find out the levered beta. So, levered beta is nothing but beta unlevered beta into 1 plus d by E into 1 minus t. So, d by E is the target company's debt equity ratio, and tax is the target company's corporate tax rate. So, this is there. So, so this particular model is useful for those companies where the share price is not listed, unlisted company, but still we like to use the CAPM, which requires cost of capital, which requires the beta for that matter, and this beta can be used as a proxy for the beta for CAPM model. So, like that we have got the valuation of the firm, and we got the value per share is 13.14, and then we have got different other approaches for the valuation. We have got a private equity approach. In the private equity approach, what happens? Private equity players is actually something like the next level of venture capitalist. Venture capitalists actually invest in a very high risk companies, but private equity players actually invest in a established entities with a lot of growth potential, but a lot of risk is also still there. So, the valuation is done as per one of the approach that you have already discussed, but if they are using something like a discounted cash flow approach, they rather use a very high discounting rate. Instead of using a normal discount rate of 15-17%, they use a very high discount rate, because the risk involved in this particular cash flow is going to be very high. So, that is the fundamental difference in the private equity players approach, and so that is the only difference there. Then we have got valuation for the mergers and acquisition, where you talk about the valuation approaches. In the merger acquisition, what happens? The valuer or the company who is the acquirer is going to have a control over the company also. So, any value that you found out in different approaches, dividend model, relative valuation model, or the free cash flow approach, that gives the value per share. Let us say the value per share comes to rupees 30. So, that is something from the retail investors point of view, but since the valuer, that the particular company, the acquiring company is going to have a control over that. So, in that case what happen, they will be typically adding something like control premium, which may depend upon the past M&A transaction, driven by past M&A transaction. If the control premium is let us say 10%, so the value per share is going to be 30 plus 10% of 30, that becomes now rupees 33 per share. So, this thing is, this is the price to be paid per share as far as the merger acquisition transaction concerned, whereas 30 rupees is going to be paid when the retail investors is going to value the shares. So, with this we have discussed different methods of valuation. We started with asset based valuation, then we talked about relative valuation approach, the comparable company approach in the first session, and in this session we talked about the different cash flow based approach like your dividend discount model and free cash flow from the firm, free cash flow the equity. You also touched upon the special cases of valuation in case of private equity players case or in mergers acquisition case. Thank you.